Hey everyone, welcome back to Corporate Decoder, the place where we try to peek behind the curtain and see if these companies are really as shiny as they claim to be, with today's report showing some interesting tactics for managing investor perception, and it's a bit of a mouthful. Let me tell you. So we've got a filing here from Spirit of America Investment Fund Inc., a document that's supposed to tell us how their various mutual funds have been doing over the first half of 2025. And while most of this is pretty standard investor speak, there's some juicy detail in the numbers if you know where to look. And trust me, we do. Before we dive in, make sure you're subscribed, because we break down these SEC filings so you don't have to. And if you want to join a community of fellow curious minds, check out our Discord linked in the description below. Alright, first things first, this is a certified shareholder report for registered management investment companies. It's basically a fancy way of saying they have to tell you what they're investing in and how much it costs you to have them do it for the period ending June 30, 2025. And they cover a whole bunch of funds here, like the Spirit of America Income Fund and the Spirit of America Large Cap Value Fund, among others, each with slightly different investment goals. Let's talk costs, because that's where the rubber meets the road for your money for a hypothetical $10,000 investment in Class A shares of the Spirit of America Income Fund. You would have paid about $58 for the last 6 months. That's 1.15% of your hypothetical investment. That might not sound like a lot, but it adds up over time, and imagine that on millions of dollars. Now, what did they actually invest in? Well, for the Spirit of America Income Fund, it's a pretty diverse mix. But look at this, other sectors makes up a whopping 29.6%. That's a lot of money where you and I might not know exactly what's going on. That's a bit of a red flag for transparency right there. They also have significant positions in tobacco at 7th rate per 9%. These breakdowns give us a glimpse, but that big other sectors bucket definitely piques my interest as to what's hidden in there. Let's look at a different fund, the Spirit of America Large Cap Value Fund. For a hypothetical $10,000 investment in Class A, shares your costs for the last 6 months would have been $78. That 8.53% of your investment, a little higher than the income fund. And what they invested in looks quite different too. Technology is a massive 38.7% of their assets, followed by financials at 9.6%. and industrials at 8.5%. This shows a clear bet on growth sectors, which can be great when those sectors are booming, but also carries risk if they falter. Interestingly, the Spirit of America Real Estate Income and Growth Fund is heavily concentrated in real estate at 95.1% of its net assets. That's a huge bet on one sector, with only tiny slivers in other areas like utilities and communications. This kind of concentration can lead to big gains if the real estate market does well, but also means significant losses if it doesn't. Your cost for Class A shares here was $79 for a $10,000 investment, or 1.60%. This is on the higher side for this fund type. And then we have the Spirit of America Utilities Fund, which, as you might guess, is almost entirely invested in utilities at a massive 91.4%. This is a fund that aims for stability and income, and this sector concentration reflects that the cost for Class A shares here was $79, or 1.53% of a $10,000 investment. Now, skipping over to the financial statements, we can look at the actual numbers behind these funds. Let's focus on the Spirit of America Income Fund. First, here we see its schedule of investments they own, a lot of corporate bonds making up 13.05% of their holdings, and municipal bonds at a massive 62.55%. This confirms their strategy of seeking high income from a mix of different fixed income sources. This trust also has a line of credit, which is a bit of a double-edged sword. It provides flexibility, but also adds debt costs. Looking at the income fund's total investments, they are valued at over $56 million. This is financed by over $57 million in net assets, which tells us they have healthy funding. But importantly, they still have some liabilities like their line of credit outstanding, adding a layer of risk. Let's jump to the Large Cap Value Fund's schedule of investments. Here, technology stocks dominate with 38.72%, and they hold a significant amount of Apple Inc. shares valued at over $7.9 million, and Microsoft Corp. valued at over $9.5 million. This is a big player on big tech. The Large Cap Value Fund's total investments are a staggering $198 million. They are financed by nearly $197.5 million in net assets, indicating they are using leverage or have some liabilities factored in, which is a sign of aggressive management. For the municipal tax-free bond fund, their schedule of investments shows a heavy concentration in municipal bonds at 98.9 from California, Florida, and New York, suggesting a strategy that aims for diverse tax advantage income. This fund also has significant borrowing, showing they're actively managing their capital structure. The municipal tax-free bond fund's total investments come in at over $27 million, with net assets slightly higher at over $27.5 million. This indicates a very tight leverage situation, which can magnify both gains and losses. Back to the income fund, their schedule of investment showcases a mix of corporate bonds and municipal bonds. They have a significant holding in MetLife Inc., with bonds valued at over $1.7 million and another over $1.3 million. This fund is operating with borrowed money as well through its line of credit, which is important to note. The income fund's total investments are valued at over $56 million, with net assets a bit higher at over $57 million. This shows a strong financial position, but remember, those corporate and municipal bonds carry interest rate and credit risk. Finally, the utilities fund focuses almost entirely on utilities, with over $34 million in common stocks and a small amount in money market funds. This is a defensive play by design, focusing on stable income generating companies. The costs here for Class A shares were $79, or 1.53% of a $10,000 investment. The utilities fund's common stock holdings alone are valued at over $35 million, with a significant portion in NextEra Energy Inc., valued at over $1.9 million, and Vistra Energy Corp at over $1.6 million. This fund is clearly positioned for a stable and predictable income stream. Let's dive into the operational side of things, particularly the expenses. The Spirit of America Real Estate Income and Growth Fund for Class A shares had a net expense ratio of 1.60%, or $79 for every 10,000 invested. This is a solid middle-of-the-road expense ratio, but worth noting, the large cap value fund Class A shares had a higher expense ratio of 1.53%, or $78 for every 10,000 invested. This is still competitive, but a bit higher than other funds. The report shows they made a net investment loss of over $130,000 for the first 6 months of 2025, which is not ideal for a fund focused on value. For the municipal tax-free bond fund Class A shares, the expense ratio is a more attractive 0.93%, or $46 for every 10,000 invested. This fund actually saw a net loss of just $590 during the period, which is pretty good considering the market fluctuations. The income fund Class A shares have an expense ratio of 0.90%, or $45 for every 10,000 invested. This fund also showed a net loss of over $3 million, which is quite concerning considering its focus on income generation. And finally, the utilities fund Class A shares have an expense ratio of 1.53%, or $79 for every 10,000 invested. This is on the higher end for a utility-focused fund. Now, for the really interesting part, buried in the additional information, they talk about the approval of their investment advisory agreement, and frankly, it's a masterclass in corporate doublespeak. They praise the advisor for extensive services, a high level of service, and a good track record, but when you look at the performance data, they provide the municipal fund underperformed its peers for long periods. The real estate fund also underperformed its peers for significant periods. The value fund looks better, outperforming its peers in many cases, but the fees charged by the advisor for all these funds are consistently above the median or industry average. This narrative attempts to justify higher fees by highlighting the quality of service and the advisor's dedication. Especially noted attempts to justify higher fees by highlighting the quality of service and the advisor's dedication, especially noting the increased regulatory burden on smaller fund families. But the core message is they have to pay more for management even when performance isn't stellar across the board. And about those fees, the board acknowledges the management fees are higher than the median for most of these funds, but they say it's not unreasonable likely because the advisor is doing a lot of work and the overall family of funds isn't massive, meaning those fixed costs are spread thinner. This also touches on economies of scale or lack thereof for these smaller funds, saying they aren't really achieving significant economies of scale yet, which justifies the higher fee structure. Because of this report, we see a company that is trying to manage its image by highlighting its efforts in regulatory compliance, while also justifying its fee structure based on the quality of service and the complexities of the business, especially for smaller asset managers. It's a delicate balance of proving value while also managing costs that are likely higher for them than for larger competitors. So what's the story here? Spirit of America Investment Fund Inc. is navigating a complex landscape. They offer a variety of funds with differing investment strategies, from aggressive growth plays in technology to stable utility investments and safe haven municipal bonds, but the persistent theme is elevated management and operating expenses across many of their funds, which, while defended by the narrative of quality service and regulatory burdens, does put a dent in potential investor returns, especially when fund performance isn't consistently outperforming its peers. The concentration in certain sectors like real estate and utilities shows a clear strategy, but it also amplifies risk. Meanwhile, the justification for advisory fees, while understandable from a business perspective, is a constant point of friction for investors seeking the absolute best bang for their buck. It's a company that's trying to do a lot of things for different types of investors, and the financial disclosure shows us both their successes and their ongoing challenges in a very competitive market. That's our take on Spirit of America Investment Fund Inc.'s latest filing. What do you think about their fee structure and performance metrics? Let us know in the comments below. If you found this breakdown helpful, give it a thumbs up and subscribe for more deep dives into corporate filings. And don't forget to join our community on Discord, the link is in the description. Thanks for watching and we'll see you in the next episode.